Hello, my name is Christian Madarasz, and I'm one of the instructors at North Island College, and this is the first video of the Accounting 1 course, College Bookkeeping. And as you can see, this is the textbook that we'll be using for this course, the 13th edition. I'm going to run through this PowerPoint a little bit quickly, but what I wanted to start off with right off the bat is this. For many of you, this is the first time that you've ever taken any sort of financial course. And for many of you, you've never had a business or never had to worry about the bookkeeping for a business. And some of you have never even written a check in your life. So I just want to say that throughout my years of teaching this course, so I've been teaching this course for about 10 years now, and it's always the same. You'll be going through a very steep learning curve. And when you feel like you're just not getting it, just please be reassured that you're exactly where you need to be. Throughout the course, I've had students come up to me in tears and frustrated and everything else. And one story to share is one time I was teaching this course at a university, and at the beginning of the course I had about 30 students, and everyone was struggling. It was just hard and hard and hard. And I kept saying, just persevere, persevere. One day it'll all make sense. And the course progressed, and after a period of 3 or 4 months, it was time to write the final examination. So we're in the classroom, and I'd handed out the final exams, and one of the students who was there, she piped up and she said, "Hey, remember when we found this stuff hard?" And everyone laughed because they had gone through the process, they had gone through the steps, and they learned that the reason you're taking this is because you don't know it. So you're bound to feel confused, you're bound to feel frustrated. It's exactly where you need to be. And trust the process, go through the steps, don't take shortcuts, do the work, and have faith that in the end, this stuff will be very easy for you. So let's get started. In this chapter, there's a number of things that are spoken about. So I'll just go through a lot of this stuff. The accounting, it's kind of fallen into, people do their books generally nowadays to see how much taxes they have to pay. And I have my own accounting business as well as being an instructor. And we're really working on getting business owners to understand that it's more about just knowing your number to file your taxes. So the accounting work provides information to the managers, so they know staffing numbers, they know the cost of staffing, they know about overtime rules. It provides it to the owners who know whether they're actually making money in the business or whether there's any profit available. They have money for the investors. So people that are investing, they want to know that the business is profitable and that their investment's not going to waste. And the government agencies, of course, is the tax stuff. As far as businesses go, there's different types of business organizations. Any person that starts a business just on their own, their term, the term that we use for them is a sole proprietor. So it's one owner. If you get 2 or more sole proprietors together, it becomes a partnership. A third type of business classification, or business organization, sorry, is called a corporation. And this can be actually as small as having one sole shareholder employee. And it's a government, what's the word I'm trying to use here? It's a way that we can set up a business so that it's its own individual. So a business number is created for this. A corporation is basically a legal entity, it's a person. And the last type of business organization is a not-for-profit. It doesn't mean it shouldn't make profit, because any enterprise needs to make a profit to continue going. But the main thrust of a not-for-profit is that it provides benefit to society. So all of these different businesses, whether it's a proprietorship, a partnership, a corporation, they have different classifications. So one would be a service classification, which means that they provide information to clients. They don't sell anything other than their time. There's merchandising corporations or businesses which make their own products and sell their own products. Or, for example, it could be Walmart, or in this example, it says Sears. And the next would be manufacturing. So they actually create their own products and then sell them to resellers. And the example given here is Ford. Also, when you're looking at who would be using these financial statements, this financial information, there's internal people, the internal stakeholder users, which are the officers, the controllers, managers, auditors, and then there's the external ones, so the lenders, the external shareholders, the tax agencies, the customers need the accounting information, and sometimes with social enterprises, the community also needs that. Now, one of the nice things about bookkeeping is that every business needs bookkeeping done. So there's all sorts of opportunities out there for you when you graduate this program to be able to apply these skills in a business. And it's something that I've been doing myself for 25 years, or actually closer to 30 years now. And I've done different things from working in managerial positions for construction businesses to, in my own practice here, having a taxation business. And I've worked as a financial planner before, and also preparing financial statements for our customers or different businesses that we work with. And lastly, this has actually given me the opportunity, the skill, to teach it to people like you. There used to be different accounting designations, chartered accountants, certified management accountants, or certified general. And back in 2014, these were all amalgamated into one chartered professional accountant designation. There's also some bookkeeping designations that are in the works. They're not finalized yet, but the IPBC is a good one to look at if you're interested in getting a designation as a bookkeeper. Now there's, I'm just going to kind of skip through this stuff really quickly. Generally accepted accounting principles. These are, they're generally accepted, which means that we have all agreed in North America to follow some of these guidelines. And it's surprising that there are different interpretations of these rules across North America, as well as across the world. So for entities that have to do international reporting, we have this International Financial Reporting Standard. So it's just a set of rules that all international companies should follow. Okay, into the nitty-gritty, the accounting equation. The very first thing, assets equal liabilities and owner's equity. So what this means is that things have to be in balance. So assets is on one side, the liabilities and the owner's equity are on the other. So if you don't understand the terminology, assets are things that we own in the business. So they're things that have value. They could be tangible things like cash or supplies. It could be actual physical equipment that you own. It could also be intangible things such as accounts receivable, which is what people owe you. So if I sell something to somebody and they say, oh, I'm going to pay you next Tuesday for your services today, that's an account receivable. So I own that right to being paid in the future. On the other side of the equation are the liabilities. So liabilities are things that you owe. They're obligations that come due in the future. So if I was that person and I go and I buy my lunch from the restaurant across the street and I say, oh, you know what, I don't have any cash, I'll pay you tomorrow. I owe them money. I would record that on my side as an account payable. And interestingly enough, they would record it on their side as an account receivable. And the last part is the capital account. So the capital is the owner's investment in the company, but it doesn't always mean the amount of cash they put in. It could be that they put in equipment that has some value. So that would be one side of the equation, would be the asset value. Maybe they put in something, a computer worth $1,000. So on the asset side, it says $1,000 value for the computer. On their side, the capital side, it would say $1,000 owner equity or capital to offset and balance the equation. All right. So the accounting equation. When everything's put together, all of these assets on the left-hand side should equal what is owed to creditors and what is owed to the owners. So this is the liabilities are owed to people outside of the organization. The owner's equity side is what is owed to the owners. That's one way to look at it. So in simple terms, the liabilities and the owner's equity are termed to be the equities of the company. So again, it's what's owed to creditors and what's owed to the owners, financial claims. And the other side are the assets. That's all the stuff that's owned by the business. So this formula can be rewritten in different ways. So assets equal liabilities and owner's equity. You can also rewrite the formula to say assets minus liabilities equals the owner's equity, or assets minus the owner's equity equal the liabilities. So it's simple math. There's a term that you need to be aware of. It's called a shift in assets. And it's normally when something happens where there's an increase in an asset and a corresponding decrease in an asset. So a basic example would be if a company purchases a piece of equipment with cash, the equipment value would go up and the cash value would decrease, it would go down. The total of the assets wouldn't change. So if I had $1,000 in cash and I decided to buy a $700 computer, my cash would go down $700, so I'd have $300 in cash. However, my equipment would go up by $700. So overall, my total assets would still equal $1,000. So that's called an asset shift. Now on page 37 in the textbook, there's exercise 1, and it goes through some basic examples of how do we just make sure everything's balanced. And as you can see, the blanks are filled in here because it's simple math. On the left-hand side, 19,000, we have to make it so that on the right-hand side, the total equals what's on the left. So 15 plus 4 is 19. On the right-hand side here, we have $15,000. So the left-hand side, that's equal 15. And here, 10, I have 4,000 on the right, 10,000 on the left, so I need 6,000 to make it balance. When going through and preparing different transactions, this is from page 37, exercise 1-2A, and it's got some words. And as we go through this course, the wording will become increasingly more vague. Right now, the wording's straightforward. It says, Maddie invests $130,000 into his company. So the very first entry is, there's cash, $130,000, equity, $130,000. The next, the company buys equipment for cash, $1,100. So the asset, the cash goes down for the $1,100 that was spent, and the equipment goes up. This is the shift in assets. There's nothing that happens on the liability side. Entry C, it says the company buys equipment on account for $950. So company buys equipment on account. This is actually in the wrong spot. Whoops, let's just go back a second. So on this slide, I didn't check these slides, and I should have. This $950 should be under the equipment side, $950 there. And the accounts payable increases, so the assets have increased by $950, and the liabilities have increased by $950. So when we're looking at these things, the assets, the liabilities, and the owner's equity, these form what are called the balance sheet. The balance sheet, as the word implies, is something that's in balance. So the total of the asset side should also equal the total of the liability and owner's equity sides. And what this is, it's a snapshot in time. So it's not sort of an ongoing year, here's how much money was made in the month of June. This is just a snapshot. It says, at September 27th, 2018, this is how the business looked. So in this example, this balance sheet says, as at September 30th, 2019, on that date, here's a snapshot of what the balance sheet looked like. The company had $18,000 in cash, had equipment worth $14,000 cost, and the building was $20,000 at cost. So that's $52,000. On the liability side, there's amounts owing to creditors of $15,000, and there's amounts owing to the owner, his capital, of $37,000. This represents his investment in the company. The other side of it, so this is the assets, liabilities, and equities. On the other side is showing how much money is earned and how much money goes out to earn that money, the expenses side. So some words that you need to be aware of. Revenue. Revenue means something that is sold. So when I sell something and I have money that's owing to me for this, that's deemed to be revenue. And in the equation, it increases owner's equity. And we record this when it's earned. So not when it's paid, but when it's actually earned. On the expense side, these are the costs of running the business. And these will, over time, decrease the owner's equity. And we record these when they are incurred, not when they're paid, but when they're incurred. This is called the accrual system. So revenues are when they are earned, not when they're paid. So if I sell something to somebody and they say, I'll pay you tomorrow, or I'll pay you in a month, I record that revenue as though it's owed to me right now. So I would say, okay, I sold you something for $1,000. I say I have $1,000 of revenue and I have $1,000 of accounts receivable. And then when they actually pay me the money, I say, oh, now I've got $1,000 in cash and I reduce my accounts receivable. And that's the same with the expense side. If I go out and I buy something, I buy a computer, I take the computer home and I say, I bought this $700 computer, so I increase my equipment by $700, and I increase my accounts payable on the liability side by $700. When I go to pay that bill, I decrease my cash by $700 to pay the bill, and at the same time I decrease my accounts payable on the liability side by $700. Don't worry if you're confused, this will all make sense. Remember, this is the first lesson. So, revenues minus expenses, that's the basic formula to tell if you've made money or lost money. If the revenues are greater than the expenses, we call it a net income. If the expenses are greater than the revenues, we call it a net loss. There's some things that happen where they don't affect the revenue or the expenses, and that is if the owner takes out money or assets from the company. So as the owner of my company, if I decide to take $1,000 out of the company for myself, that's not an expense. That's an owner withdrawal. So that needs to come off of my owner's equity side. I'm basically paying myself the money that the company owes me on my equity, but I don't record that as an expense. So now as we expand this equation, the first part of the equation was assets equals liabilities and owner's equity. The assets can be broken down into cash, accounts receivable, computer equipment, could be all sorts of inventory, supplies, things that are owed. The assets would go on the left-hand side. The liabilities, accounts payable, perhaps there's money owing to the government for taxes payable, maybe there's bank loans payable. Those would all be liabilities. And then under the owner's equity, we have the initial capital. We have withdrawals which are taken off. So if I pull money, or in this case, if B. Bell pulls money from the company, that is subtracted. The revenue that's earned is added in to the equity, and the expenses that are incurred is taken off of the equity. And overall, when everything is said and done, still everything on the left-hand side, when you add it all up, should equal everything on the right-hand side when you add and subtract the different things. So on page number 37, exercise E1-4A, there's a number of different things. Now I've included the PowerPoint into the course, so you can go through this PowerPoint and work through these different examples, but I'll work through this one for you right now. So the first one says, B. Bell invested $60,000 in Bell's computer company. So the entry is $60,000 of cash, $60,000 to capital. Entry B, bought a computer equipment on account for $7,000. So on account means it hasn't been paid for yet. So we increase our computer equipment and we increase our accounts payable. Now if I add everything up, I've got $67,000 on the left-hand side, the asset side, $67,000 on the right-hand side, the equity side. Entry C, paid personal telephone bill from company bank account, $200. Personal telephone bill. So it's not a business expense, so this personal bill is actually a withdrawal for $200. And $200 of cash from me out. My assets equal my liabilities and equities. Entry D, received cash for services rendered, $14,000. My cash goes up $14,000 and my revenues go up $14,000. Add everything up. $80,800 on the left-hand side, $80,800 on the right-hand side. Everything's still in balance. Next entry, I billed my customers for services for the month, $30,000. I billed them. So I haven't received the cash yet. I billed them. This is an account receivable. So I record my revenue, increases my revenue by $30,000, and my accounts receivable increases by $30,000. Entry F, I paid my current rent expense of $4,000. So my rent expense, $4,000. Here, this should be $4,000. It shouldn't be a negative number. So again, when I add everything up, this should be 60, 104. This doesn't look like it's right. And I hate it when the slides aren't right. So the idea is that these expenses, oh, I see. Sorry, they're subtracting the expense. So I'm just thinking how it gets entered. So they've taken $4,000 off. It decreases the owner's equity, which is what they're saying here. So in the end, it should be $106,800 on both sides. So that entry is correct. And entry G, I paid supplies expense of $1,500. So my expenses increase again, so I'm reducing my owner's equity by $1,500, and my cash goes down by $1,500. Again, my assets equal my owner's liabilities. Okay, so now I've got everything in there. Now, if the owner takes out $100 for themselves for personal use, my cash goes down by $100. And in the withdrawals, I show that there's a $100 withdrawal as well for the $300. Now, don't worry too much about the negative signs and the positive signs that are happening here. As we start to progress, we'll start to use debits and credits, which means left side and right side. This is just showing how this affects the overall accounting equation. As you get into lesson 2 and lesson 3 and onward, this accounting equation actually starts to become more of a concept than an actual way of recording things. Feeling overwhelmed yet? Well, you should, because we've just covered a whole bunch of stuff in a very, very short period of time. So good on you for still being here if you're listening to it. And if you're not, well, then you're missing out, because the best is yet to come. Preparing an income statement, a statement of owner's equity, and a balance sheet. So there's different types of statements. So remember that before, a couple slides back, we talked about the balance sheet. The balance sheet has the assets on the left-hand side, and on the right-hand side, it had liabilities and the owner's equity, and everything was imbalanced. The one statement that we like to see is called the income statement. So as we're going through, we need to do the income statement first, because that will take the revenues, and from the revenues, it subtracts all of the expenses and lets us know what our net income or our net loss is. After we have that, we can say, oh, the net income that we had would come over to this statement of owner's equity. And on that statement, it says, here's the beginning balance of the owner's equity plus whatever the net income is, or whatever the net loss was. And that gives the ending balance for the owner's equity. That number then goes over to the balance sheet to make sure everything's in balance. So it's important that when you go and prepare these statements, they have to be done in the correct order. The income statement, then you do the statement of owner's equity, then you do the balance sheet. Because if you don't do it in that order, on your balance sheet, you will not have the right balance, because your owner's equity number will be incorrect. So income statement, revenues minus your expenses equals your net income or loss. And this covers a period of time. And this period of time can be anywhere from 1 day up to 1 fiscal year or 1 calendar year. So a fiscal year is any 12-month period. A calendar year is any 12-month period starting in January and ending in December. So fiscal years can actually have different year ends. So you can run a fiscal year starting July 1st and going over past December and ending June 30th. That's a fiscal year. The statement of owner's equity, it shows us over a period of time. So the same as with the income statement, you would say for the year ending, or for the 2 months ending, or for the 4 months ending, whatever. It's the same with the owner's equity. You have the beginning balance of the owner's equity, you show the net income, you take off the withdrawals, or you subtract the net loss, and that gives you the ending balance. So here's an example, and this is from exercise E 1-5A. And it's just given a bunch of information saying, here's our cash accounts, our accounts receivable, our office equipment. And it's asking you to make up financial statement. So the first thing you have to be able to do is you have to understand which items are assets, which items are liabilities, which items are equities, which items are revenues, and which items are expenses. So the nice thing about the text right now is that if the description says something expense, then you're pretty much certain that it's going to be an expense. Okay, so that's your first hit, or your first hint. If it says that it's got somebody's name and it says capital or withdrawals, those will be your equity accounts. Okay, the next part is determining what you own. So cash is the obvious one. I own cash, I own accounts receivable, I own equipment, those are assets. And as you go along, you'll start to add to that, that repertoire of knowledge, adding more things to the assets. And the liabilities are accounts payable. Words that end with payable are generally liabilities. And then you'll have the revenues, and that can be all over the place. You could say sales, you could say professional fees, you could say some word with fees in it, but make sure it doesn't have expenses, okay? So this will all make sense as you progress. Here's things to recognize when you're doing up the income statement. We don't just say the date. The date is for the balance sheet. We have to say a period of time for the month ended November 30th, 2019. Then we'll list our revenues first. Notice how I indent over to the right. For my expenses, then I list my different expenses. I do a subtotal saying here's the total expenses. And then I do my net income. And the one thing that's missing on here is when you actually have your net income, make sure you put a double underline. That means that everything's done for that page. So you make up the double underline. So I know that in this case, for Frederick Realty, they have a net income of $1,450. So this net income figure is going to go over to the statement of owner's equity. The statement of owner's equity starts with S. Frederick's capital at the beginning of the month for $9,000. The $1,450 from the previous month, as you can see there, after $1,450, I add that into the net income. There were withdrawals of $120, so I subtract the withdrawals. So I have an increase in capital. Now again, note the date for the month. It's not just a snapshot, it's for the month. So during that month, there was net income. During that month, there was withdrawals of $120. During that month, there was an increase in capital. That's the ending balance. This 10,330, and there's nice double underlines there, perfect. The 10,330, then we're going to take that number and it comes over to the balance sheet. Now the balance sheet is a snapshot saying on the date of November 30th, not for the month, but on that date, here's the snapshot. The bank balance was $4,800. There were $1,230 owed to us. We owned equipment for $8,300. So our total assets were $14,330. We owed $4,000. The capital, because of the difference between the revenues and expenses, changed to $10,330. And that means that overall, we had $1,430. So here's the flow. Starts with net income. So revenue minus expenses and net income. That net income goes to the statement of owner's equity. So you have your beginning balance of the capital, your net income, you take off the withdrawals for that period, you have your ending balance to the capital, that goes to the balance sheet, so you record your assets and your liabilities, and that ending balance for the capital. Okay? I know there's been a whole bunch of stuff in the My Accounting Lab. There's copies of the PowerPoints. I also included PowerPoints in the course under the student resources at the left menu. There's some flashcards and other things there. So hopefully this isn't too overwhelming, but remember, if it felt overwhelming, you're exactly where you need to be. And other than that, good luck, and I'll see you in the next lesson.